Hello, and here's the last part of our discussion with Joe Czempoyesh. Again, as always, let us know if you have any questions.
Well, I think you partially answered my last question here. We had an investor who was more interested in student rentals
Yeah,
specifically,
sure.
right? And I know things have changed there dramatically over the last 4 or 5 years. From when I was advising investors like that, I was always telling them, yeah, it's a different type of investment. If you can stomach a little bit more risk as far as potential damage to your property, you're dealing with a large number of students in that rental property compared to one family or young professionals at another rental property.
Right,
If you can stomach that, the payback was that you were getting really good cash flow on those properties. But
right.
then 4 or 5 years ago, all the lenders kind of switched their way of looking at student rentals to the point where I think the A lenders don't even want to touch student rentals anymore. And
Yeah,
some
it's
some of the some of these invest I'll let you
yeah,
answer,
yeah,
but some of
yeah,
these investors, we're looking at putting 20% down, um, and taking on that risk and the extra work that goes along with renting out to students. But their cash flow, they were getting such great positive cash flow, they were willing to take that trade off.
yeah,
So now when they're looking for uh, some lending for that particular property, they're getting, I've run into people that are getting the lenders coming back to them and saying, I could only get a B lender to approve you. You need
yeah,
to come up with 35% down. You're going to be up at 7-8% interest, and
for
it's
sure.
turning them away a little bit. So I
Yeah,
know, what happened there, I guess, is the question as far as the lenders go,
yeah,
specifically looking at student rentals. Because this area, we have the universities and the college, so it's
right.
a question that comes up a lot.
Such a great question. And I seem to be focused on things that have changed in the last little while, but one constant has always been student rentals, and it's why I chuckled. I've been a mortgage broker since 1991, so an awfully long time. And a constant in this industry is that you could really never borrow on student rentals properly in the prime market. So what changed? Nothing. Kind of.
Oh
What
yeah.
has changed is a lot of times the lender didn't know it was a student rental. Like that was really it. It's how it was listed, how it was purchased, what was the process, how did it look. It possibly was a student rental, but the lender wasn't wise to it. Lenders have always been averse to student rentals because of the property damage, right? You've got students and party, and they, no, hey, I was a student. I know what it's like. But there's a little party here and there. You have to fix the drywall, repaint. Lenders don't like them, right?
Yeah.
Never have. And there are outlets for it. Don't get me wrong, but it really goes back to the question where you're in multiple properties and you're paying a higher rate. The return from student rentals is, in my experience, the biggest return if people can manage the tenants, right? Then I have never witnessed greater returns than on student rentals, even at higher rates and fees. So what we've always had in the industry is lenders have always required a bigger down payment when they looked at student rentals. They've never really been fond of them, right? And the B market eats them up, right? Because they know the return is there. So usually it requires a bigger down payment. Many times, if we're trying to deal with prime lenders, it goes to 35% down, right? There still are prime lenders that do it. We've always had credit unions and some prime lenders, some banks that have done them with higher down payments. The B market is open to them. Higher rates, yes, sometimes 6, 7, 8% with fees, but the return is still there because the rental income is huge, right? And in a nutshell, that's it. That's been a constant in the industry for quite some time. Yeah, everything is becoming harder to do these days. So yes, of course, it's been more difficult on that. But that's always been something that lenders have not particularly been fond of, and always made it a little bit more difficult. But as an investor, when we're into our multiple properties, or we're into student rentals, the rental income's big, right?
Yeah.
you know you potentially have within one single family resident, it can basically be a a 4 or 5-plex in disguise. You know what I
Yeah.
mean?
Yeah.
Right? You've got all those rents coming in. So it's fairly profitable. Yeah, you might have to go in and fix the drywall or put some paint on there or whatever the case may be. And lenders know that. They don't quite like it, with that. But so try to answer your question in a simple form. I think that's always been one of the constants that I've faced. One of the constant challenges in the industry is that prime lenders have always shied away from student rentals. There's always been some prime lenders that will do it with a bigger down payment, and the primary applicant has to be a little stronger. So they're always looking for a little bit more well-heeled individual, income and credit-wise, right?
Yeah.
But the B market is always there at higher rates and fees, and they'll eat it up because they know that there's profits to be had there, right? So I don't know if that answered the question or raised a
Well,
bigger
that's
question.
interesting because I've had others tell me that that kind of changed a little bit. You're saying it hasn't. I wonder if what has really changed is their level of awareness. Like the
Yes,
lenders now know you're within walking distance to a college or university, they're going to flag it and basically look at it
absolutely.
a little closer. Where you could
Absolutely.
have hidden it, like you mentioned earlier, somebody might have hidden it or disguised it as a traditional rental 5 years ago, and now they're not getting away with that. So
Yeah, and sometimes Vic, even the need for an appraisal, like a lot of times when the market is, when we're not in the stress test market, let's put it that way. We're in a different world right now with where everything that we have, has a different level of scrutiny to it. Where we've had no questions asked time, right? You know, we have done mortgages with no income, no credit, no down payment kind of thing. Like we have had those times, and no appraisals, right? And now even with the appraisal, hey, why does this house have 3 sinks, 4 sinks, 4 bathrooms, kind of thing. And yeah, red flags are up. It's becoming increasingly more difficult to do anything these days. So of course that's going to make that even that much harder. But it's always been a challenge to get those done. Always, always, always. I remember, we had, in the 90s, we had 2 credit unions that would do them, and that was it, kind of thing.
yeah,
Um, but it's changed. The market has changed. But historically, that's always been a challenge. Suffice it to say, but big returns. And then you don't look at the rate. Don't focus on the rate. And hey, a penny saved is a penny earned. I hate to always go back to don't look at the rate. Don't focus on the rate. Always look at the rate, right? Like we're not going to pay a higher rate just because I'm not focused on the rate. We're going to look for the best rate that we can given the situation at hand, right? And we're going to exhaust all the rates that we can until we get there, right? But you don't be focused on a rate when you've got that kind of income coming in, and it's gonna way more than compensate you, right?
yeah. Okay.
It's funny, but as I have a lot of business for self clients, I kind of have a lot of business for self clients, and sometimes they're impacted by tougher guidelines to borrow, right?
Yeah,
And they come to me and say, I've got the ability next year, the next year, or the year after, to show a little bit more income. I'll do that. And I'm like, well, think about that for a minute. You're gonna maybe get into 43 or 53% marginal tax rate. Potentially on that extra. So just for talk's sake, on that extra $100,000, you're going to show maybe $43,000 or $53,000 in tax, right? To what? Save $3,000 on the rate that you're paying?
yeah,
Like, we always want to be careful that we're not, like I said, I'm always from the school that a penny saved is a penny earned. So I think I should always lead with that so people know where I'm coming from. I'm always trying to get the lowest rate and the most favorable terms. Always. It's just a known fact, right? But
yeah,
we don't want to spend $20,000 to save $2,000.
yeah.
So
That
we
makes
look at
sense.
that when we're looking at taxation, and we look at that with rates of return. I'm not going to buy that property because the rates 4, 5, 6%, whatever the case may be. I'm not going to. I don't want to make $3,000. You know what I mean? Like,
Yeah,
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 we don't want to focus on that. We want to focus on what's the return for me in the long run, right?
yeah.
And
I guess it's important. You got to step back and take a look at the bigger picture for sure. So
yeah,
okay. Well, that's excellent, Joe. I really appreciate your time. This has been awesome. A lot of great information. We're going to post your information up here, like I said, on each of the videos that we break this down into, so that people will be able to reach out to you directly. But
hey, great,
thanks
Vic.
for
Thank
doing
you.
this.
Thank you.
Take care.
Thank
Thanks for watching, and we hope to hear from you guys soon.